Tom's number 4 speech, and this is Kurt's number 4 speech, correct?
Yes. Okay, this is my 4th speech, but we're actually going to do Project 8, which is around using visual aids that I'll incorporate into my speech. And the speech is going to be, and hopefully everybody will benefit from this speech, but we're going to talk about investing, and we're going to talk about asset allocation. And a lot of people don't quite realize what asset allocation is or the importance of it. So we're going to talk through, kind of raise some awareness around asset allocation. It's actually, outside of first investing money into something, it's really the second most important thing everybody can focus on. I want to involve people a little bit. Who can tell me what asset allocation is? Does anybody know the term asset allocation?
Well, like from a portfolio, you might have 70% bonds to 30% stocks, or some kind of a ratio to different types of investments.
Yes, that's exactly what that asset allocation is. It's all about your investment mix. So, to kind of simply put it, asset allocation is not putting all your eggs in one basket, not having a portfolio made of all bonds or all stocks or gold or whatever it is that you invest in, technology stocks or different types of stock sectors. So we're going to touch a little bit about asset allocation. Can everybody see that? Leave that out here a little bit. So we're going to talk a little bit about that and what that means and how important it is to everybody. Has anyone looked at their asset allocation in the last year? Okay, good. A couple people. That's good. That's good to hear. That tells me you understand the importance of it and kind of keeping an eye on it. So again, it's just not putting all your eggs in one basket. So you would have many baskets to diversify your portfolio, and we're going to talk a little bit about some of those baskets. But it also boils down to 2 different things: your risk tolerance and your time horizon. So if you have a long time before you retire, before you need those assets, your allocation may be more weighted towards higher risk things such as stocks. If you have a shorter time frame or even just a lower risk tolerance, you may want to be more in the cash and bonds and some of those type of things. Can somebody give me some examples of some of the different buckets you can put? I know you talked a little bit high level, stocks and cash. Can anybody think of some other examples of how those break down even a little bit more granular?
There's onshore and offshore stuff.
International investing, yeah.
Maybe real estate.
Real estate, different areas.
Different kinds of mutual funds.
Many different types of mutual funds. So we're going to kind of break them down a little bit and just give a high level of it. So the goal would be an example of putting all your eggs in one basket. There was a lot of people that invested in technology stocks during the 90s, and they probably made a lot of money if they got out at the right time. But then those same technology stocks that just ran up through the 90s went and corrected around 2000. So if you had everything in technology stocks and you happened to get out at the right time, you might have won big. But if you didn't, you would have lost big. So because nothing's ever guaranteed to go up all the time, you want to diversify. And that's what stock allocation is all about, or asset allocation. So some examples of that is it kind of falls into 3 different categories. Some asset categories. You have stocks, you have bonds, and you have cash. For stocks, there's a lot of different ways to look at it. There's a lot of different mutual funds out there. Mutual funds that have very different specialties. We're going to talk about mutual funds because there's actually mutual funds for every one of these different areas. But stocks, you can finance those financial stocks. You can invest in just banks and financial type of stocks. You can invest in healthcare, technology stocks, services, energy, metals and mining. Each one of those is a separate subset of a stock that comes with its own risk and reward. So you can even diversify with just a stock portfolio across all the stocks. Some people diversify that way. Some people have a little bit of all these. It just Depends on what you're looking for. Again, your time and your risk tolerance. Bonds, there's a lot of types of bonds out there. Municipal, U.S. Treasuries, corporate bonds, high yield bonds. There's bond funds. There's mutual funds that specialize in bonds. Cash, there's savings deposit, which we all know we don't get much on savings deposits anymore. Money markets, treasury bills, money market funds. So there's a lot of different places to help diversify your portfolio. I think a lot of folks feel like they invest in a portfolio and they don't realize how fast and quickly your asset allocation changes. It's changing every day, whether you realize it or not. So a lot of people tend to have, I want this percentage here, as it gets invested. But as one area grows more than another area, you may find yourself, and I have an illustration of that, that they're out of whack. They're out of what you plan to do. So to kind of keep it simple, we're not going to talk a lot of detail of what all these are and the different pros and cons of each one. And I'm probably going to focus more on just mutual funds. Mutual funds can cover all of these different areas, from the money market to bond income to balanced mutual funds, equity funds, international specialty funds, index funds. Those are all different types of funds that you can invest in. What I did is I actually took a snapshot of, and I've kind of made the names a little more generic, but this is actually what happened to my own asset allocation just in the last year, just to kind of give an illustration of how fast things can change. The key with asset allocation is coming up with a plan. So in June of 2012, I revised my plan, and I decided that for my investments, I would invest 15% in the S&P 500, 17% in long-term growth stocks, 20% in large caps, 15% in small cap. Those are smaller companies. 8% in international, 10% in income and capital growth, and 15% in targeted small and big caps. That just happens to work for me with my risk, my time frame. That's what I wanted, and that's what I set them all at back in June. Well, the stock market's been on a tear, and a lot of things have changed in the last year. As you can see now in June, my allocations are much more different, and it's the column on the right-hand side under the actual allocations in June of 2013. And I highlighted some in yellow. I have a couple of rules. I don't want to invest 25% in any one place, even if it's a mutual fund that's highly diversified. It's just one of my own internal rules. I don't want to invest more than 10% in international. It's just one of my internal rules. So I've got some of these rules set that help me follow that plan. Now, if you look at it, you can see that the pie charts also show it pictorially. The S&P 500, I'm no longer 15% of my overall portfolio. It's now 33%. It's double what I wanted it to be, or what my goal is. And actually, that's in many ways a good thing, because it means that particular mutual fund has really grown. And it's grown so fast in the last year, it threw off my allocation. If you look at the last one highlighted in yellow, the targeted small and mid cap, it's much smaller. So I probably lost on paper money there. Well, a lot of people will look at it and go, well, I don't want to touch that 33% because that thing's just skyrocketed. Well, the thing that you don't know is you don't know when it's going to go back the other way. And when it goes back the other way, it could catch you off guard. And I'm probably at a risk mix that's outside of what I want it to be, because I felt in June of 2012 my risk and my time allocation should be those percentages on the left. Actually, it's only been a year. I don't want to change that. It's just the market changed it for me. So the easy part's coming up with a plan, which is what I did. The hard part is sticking to it. So you have to be disciplined to go, yeah, I've got a really big winner and I got a really big loser, but I'm actually going to take money out of that big winner and I want to re-diversify. And I'm actually going to put money back into that loser. Because over the long term, I'm not going to time the market. I'll probably never catch right before the market dives. I can sell the S&P 500 index fund, and you can't base your decisions off of what's working today is going to be a winner tomorrow. You can always go back to your plan. And it seems counterintuitive sometimes, especially like, gee, I'm kind of taking away till a year from now when your winner takes a dive and your loser went uphill, you're going to go, I'm glad I stuck with my plan. And even if it doesn't, you stick with your plan. So the main message I want to get across to everybody is, one, everybody should understand the importance of asset allocation for investing. It's the most important thing other than the investment itself. Two, it changes quickly. It'll be even more important, say I was 60 and now I've got 33% instead of 15% in that S&P 500. Well, maybe I actually want a lot more in something more stable because I'm going to retire in a couple of years. There's even more risk if your portfolio did the same thing that happened at 60 than it did with me at 40. So the other message is plan your allocation, have a solid basis for why you set out that plan, and then stick to that plan. And don't let the market's ups and downs waver you from that, because you'll be chasing the timing of the market, and as we all know, that's just not possible. No one can time the market right. So go back, be disciplined, and stay focused on your allocation plan, and then reallocate. So what I did was take that 33%, it's now back down to 15. Some of the ones that's only 1 or 2% is off, I'm not that worried about it, but if it's more than 5%, then I want to shift. And then I'll check it again in another year. So with that kind of wraps up the presentation, with the main keys being the importance of asset allocation, having a plan, and then the most important one and the hardest one to follow is being disciplined to follow the plan. So, is there any questions? Thank you.